December 2nd, 2020. First up on the agenda is just a review of the minutes from the September meeting. Any questions or comments about the minutes? Hearing none, do I hear a motion to accept the minutes?
So moved.
Do I hear a second?
I'll second.
Second.
All right, thanks. Minutes have been approved. On to the next, some housekeeping items. Appointment of the chair for December 2020 through 2021. And I've kind of thrown my hat in. Oops. Did I do that? No.
I
Sorry.
did that. I was just going to pull this up so that
All right. Yeah, so I threw my hat in for the chair for the following year. I don't know if someone has to make a motion. I know Derek was vice chair last year. Melissa, what's the process? Someone has to make a motion, right?
you could do it either way by consensus, or if someone wants to move to appoint you, we can do it formally that way as well.
Okay. Any objections to myself and Derek being chair and vice chair for the upcoming year?
None from me.
Come on, no volunteers. Chris, come on. You don't want to get in on this?
Do you want me to object to you too? I can, if you want me to do that, I can do that. No. I absolutely fully support you guys doing it. And thank you. I think anybody's a volunteer. Thank you.
Yeah. So hearing none, would this be a consensus then, Melissa?
Yes, that's fine. We'll say you were both appointed to your positions by consensus of the group.
Great. Thank you. I guess the 2021 regular meeting schedule.
I think you and Kevin had chatted about this, slightly altering our normal day and time.
Yes, correct. Yeah, Kevin and I spoke, and the draft schedule that we're presenting is the first Monday of these 4 months. So keeping with our quarterly schedule, but changing the morning that we meet and shifting from 7:30 in the morning until 8 in the morning. Kevin, I don't know if there's anything you want to add.
No, I think, having it in the morning is good. And I know a lot of people have to get to work, right? So having it early in the morning serves the purpose, and we should have enough time. So a motion to approve the minutes.
I think we've done that already.
Yeah.
All right.
Oh, you mean the calendar?
I think you're a motion to approve the calendar as presented.
Motion to approve the calendar, correct. Thank you.
So moved.
Second.
Second.
Any opposed? All in favor? Aye.
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 Thanks. Going on to the next item. Just an update on the transition for the DC plan.
Yeah, and I can tackle this, Kevin. Good to see everyone. Just a reminder, the defined contribution plan, which is currently with Mass Mutual, which of course was bought by Empower, but prior to that, there was an exercise to do an RFP, and we're now moving to ICMA for the defined contribution record keeping services. With respect to the update, we're still on track for middle of January transition. Obviously termination letters went out to Mass Mutual. Service agreements all been completed with ICMA. We've completed the investment lineup and mapping schedule. The communication has gone out. The formal letters went out last week to plan participants. The education and Amy and Melissa, correct me if I'm wrong, or Maria, the education is happening this week, I believe. I think it was started yesterday with Laura Hancock, quote unquote meeting with folks and presenting to folks around the ICMA. And there's a website launch as well. If anybody wants to take a look at it, it's icma.org /Simsbury CT. You go on that and you can actually see all of the material. The presentation actually is uploaded onto that as well, the schedule. And so barring any other issues, the blackout should happen the first week of January, and the liquidation should be January 12th, and we should be live with ICMA. So no concerns. I'll get to my portion after Chris goes, but no concerns on my end with the investments that we're presenting. I think the only thing that's pending right now is a plan adoption materials, but I think the town's working on that and should have that by the end of this week. So I guess I'll open up to see if there's any questions. Great.
This is actually Chris. This is Chris Peterson. Morning, folks. This is absolutely informational for me. We often find ourselves, curiosity, I guess you could call it as well. We often find ourselves in other aspects of town issues, sort of weighing ourselves against peers and such. Obviously, our numbers are going to skew because you're not going to have a head count that's person to person. But I'm just curious, as we're moving over such a level of AUMs and value, how does our aggregate investment amount compare to other towns in the area that we're moving to custodians? So just curious. That's just purely informational, Kevin. That it's not something you guys have anecdotally. That's okay. It's just
I think
wondering what the
Tyler
rate
probably
of
would
our
be.
account is.
It's Chris, it's a good question. It all really depends on when certain towns, specifically with the defined contribution plans, when certain towns moved away from having new employees in the pension. So, for instance, West Hartford for a 401A 457 did this, or excuse me, for the 401A did it much later. Their 457 assets are a little bit larger and are with multiple different record keepers. And so that complicates certain things. Whereas the town of Greenwich went to defined contribution structure back in the late 1980s. And so they're upwards to, $250, $300 million or so. So it really depends on when the towns kind of shifted from the pension assets. But, and I think Chris may be able to offer some insight as well. I think you're fairly large in the sort of greater Hartford area with respect to those DC assets, being, I think when we look at it, close to sort of 15 million or so in assets. Let me look at it now.
I would just offer up, Tyler, and it gives Chris, it is anecdotal. Canton got started, I think, a little bit later after you folks, and their asset total is, I think, is somewhere inside of you, a few $1 million below you. But we don't work with Avon's DC. I don't know, Tyler. I think we just did Glastonbury too, right? Is that a relatively new?
Yeah,
client?
Glastonbury is right around the same size, just a hair north, and they're actually with ICMA right now. We've been doing some work with, and this is all public, obviously, doing some work with Torrington, and that's roughly around the same size, maybe a little less. So again, competitive, but it really, there's some towns that went much earlier into the DC space than others, and therefore much larger.
Okay. Yeah. Thank you. Again, it's just curiosity, indeed. Are we of weight or value or significance, so to speak, to somebody, or are you just sort of in the middle of the mix of flow of things that get moved around from custodians to custodians? That's all. And do we get, do we enjoy any sort of additional consideration because of our size, or we just sort of get in that middle space? It's purely anecdotal. I don't want to it's just educational for me. So thank you.
We definitely, obviously benchmarked those compared to not only the municipal space, but also obviously other retirement plans. Because when you look at retirement plans, a 401k, a 403b, very similar work, right? It's the statements, it's the call center, it's the access to the investments. And so we benchmarked those. And when we completed the project, the ICMA came out really competitive. So, you got really competitive pricing. That being said, ICMA will do large city systems, state systems, so they also have sort of bigger pools as well. So,
yes, please don't anyone on this call. You guys know me. I am not injecting a question at this point to question any of the moves or decisions or evaluations you all made. It's purely just informational, anecdotal curiosity for me. So thank you.
Thanks. I guess we'll move on to the pension plans, third quarter performance. It's Chris Keshbar.
Right. Good morning, everyone. Good to see and hear, folks. What did we decide, Melissa? I've got page number references. Were you going to scroll along on the master screen? Was that?
I can do that if that's easiest for you. Okay.
Sure. Why don't we try that? Because it's obviously, I think, as folks had a chance to gaze through the materials, it's pretty unwieldy and lengthy, but we hit the highlights each quarter, as you know. So if we scroll ahead here, we'll get started with just some generic information before we dive into the plans. Just quickly on the capital market front, we've got a series of pages here. I think for the quarter now, it's somewhat in the rear view window, but folks appreciate that the appetite for risk across capital markets has proven to be pretty darn resilient, right? All things considered, certainly given the landscape, both economically and on the healthcare front. This is a representation here on the screen of global equity returns for the third quarter. And you do see the pretty pronounced march up in those markets, certainly through the first 2 months of the year. And then we did have a bit of a drawback in the month of September, particularly in the technology front, which, as you know, we've talked about in the past, has really been the place that investors have kind of garnered their attention on, those big glamour tech names that have been driving some of the broader indices. They sold off a little bit in September on some concerns around valuations and perhaps a new administration having a different take from a regulatory standpoint. Interestingly enough, and we'll kind of share that, tease this into our conversation, the fourth quarter to date, has been continued to be more of the same. After that September consolidation, markets have been going, as you know, by and large gangbusters again through as recently as last night. The S&P's up 9% in the fourth quarter. Small cap stocks are up 22% in the U.S. in the fourth quarter. International stocks are up 12.3%. So markets continue to be pretty darn resilient and are pricing in, right, kind of three things if you just think broadly about what's driving investor sentiment. The first being, right, an expectation here, and you started to see some chatter more recently that maybe a second round of fiscal stimulus is forthcoming. And that is certainly something I think investors are banking on to some extent. The expression by the Fed that they'll continue to be very accommodative with their stances and policies. You've heard over the summer, we talked about, I think in the fall, their interest and intent to keep interest rates very low and to continue to support markets. And then obviously we've seen some news, at least on balance in terms of the vaccination efforts that investors have been encouraged by as well. So we're not going to go through all the subsequent pages here, but just the landscape, again, it's amazing to us, I think, when we sit here as we come into the end of the year, that when we gathered with you, if you remember back, I think in the end of March to talk about the portfolios and markets and some rebalancing, how stressed and dislocated the markets were back then and the magnitude of this dislocations. And to think now that most capital markets calendar year to date are in the black is pretty darn amazing, and certainly something we wouldn't have expected. The reparations, both in sentiment and in markets, has been pretty darn pronounced. If we skip ahead to the next page, Melissa, just quickly, again, I don't want to linger too long here. I know this group is pretty up to speed on what's going on in the markets, but you do get just a little bit of perspective before we look at the portfolios. Quarter to date, just in terms of the breadth of the returns for the market. I mentioned the global equity markets, and you see those individual returns in the middle of the page, far left column, quarter to date numbers, of course. And again, the breadth across style, capitalization, domestic, international, and the like. And then in the upper left-hand corner, bond markets were positive as well. You can make it out there if the aggregate index, that broad U.S. investment grade index was up a little more than 0.5% in the quarter. And that appetite for risk displayed on full display in the equity markets, you see kind of permeating the fixed income markets as well. And the proxy for that, kind of under the hood there, you see corporate high yield up about 4.6%, right? So investors kind of search for yield and return sources in the fixed income markets. Kind of had that same tone, if you will, that existed in the equity markets. And then the lower left-hand corner of the page, midstream energy aside, you saw some decent outcomes in some of the other ancillary markets, the commodity markets, for example, and some of the REIT markets. So a decent quarter is the general backdrop. If we could skip ahead, Melissa, I think all the way to, if you would scroll ahead for me, I'm going to set aside these pages. It just covers in more detail everything we've talked about. So to the extent folks have questions or we need to revisit these themes, we can. This page is interesting where you landed there. If you go back just quickly, right? Everyone loves to talk about what elections mean for markets. Obviously, the election is in the rear view window now, but nonetheless, people do like to talk about this. There's this idea that certain parties mean different things for markets. The data would suggest otherwise, quite frankly, that on the bottom of the page there, if you were to kind of dig through the information, it would indicate generally what markets like are split political outcomes, generally, right? So the executive and legislative branches being of different political persuasions is tended to be the best backdrop for capital market returns. We would suggest, though, that, election effects really are transitory. It relates to fundamentally where we are with the economy and the cycle, and valuations for capital markets. Those are the more enduring things that you can imagine ultimately affect markets. So that, that's still, we'll see how this all plays out. We have had this period of somewhat elevated volatility, which is typical for election cycles as well. But at the end of the day, it really doesn't matter all that much, the political persuasion of the executive branch in terms of what happens in markets with, any type of a longer runway and viewpoint. That's probably enough on backdrop. If we skip ahead, Melissa, just to, I think the next section, no changes to our investing viewpoints. We'll flesh this out a little bit when we get to the portfolios in just a minute. If we continue to scroll ahead here and start to get into the three plans, just from a governance perspective, quickly, as everyone knows in the group and as a reminder, right, trying to visit other aspects of your responsibilities beyond markets and portfolios each quarter. This quarter happens to be just a high-level review of the municipal landscape actuarially. And this certainly isn't in any way to supplant the work that Becky and the team does at Milliman. It's simply some information that we teased out. And if you go to the next page, Melissa, you'll see here some broader trends across municipal markets. So we went into state CAFRs across the state and tried to codify the data and kind of see where, the state stood, if you will, on a couple of different metrics: funded status, discount rate, some investment returns as well. No surprise to this group, right? You can see there in the upper left-hand corner of the page that, the vast majority of plans, maybe vast is too strong a word, the majority of plans in the state, funded somewhere in the 70 to 90% range or thereabouts, right? As you all remember, right? The three plans in town are, vary from the 74, 75% funded range up to about 82% funded, I think. So from a funded status standpoint in isolation, the three plans look, very much like state averages, if you will. You see there down in the bottom half of the page, statewide, about a 75% average funded rate across the plans that we were able to sample. The other trend that is all too familiar to everyone, of course, in the upper right-hand corner is what's going on with discount rates, and this continued and fairly pronounced march to lower discount rates. You see there through previous fiscal years, if you can make out the cohort colors there, no surprise, right? Moving from the upper 7s and 8% type discount rates into levels now that more inside, for example, 7%, 6 3/4, 7.25% being the most popular, if you will, cohort. And as we all know, right, the three town plans at 6 3/4% as of the June fiscal year, you really kind of plot right in line, if you will, from a comparative standpoint with state averages. So I don't know that there's anything here telling or actionable. We thought it was interesting information and wanted to share it with you just so you had it. But kind of representative attributes statistically with the plans versus these broader state averages, again, on a high level. And recognizing there's nuances and particularities across individual plans and towns that drive some of this activity as well. But broader, kind of, it looks and feels like what you see around the state. If you go to the next page, Melissa, the other thing, right, that goes in hand with this is investment return. This is an admittedly busy chart there. The visual is just simply fiscal year returns, and as we know, markets have bounced around a little. Probably more telling, I think, and interesting for the committee, you'll see there down in the first bullet on the bottom half of the page, fiscal year returns, 2019 returns, the 3-year annual through 19, and then the 5-year annual as well. We didn't put the data on the page here for the town plans, but it's interesting. It lays almost right on top of these numbers. So the fiscal year number there, you see 5.7 statewide. I think the town plans net of fee in that fiscal year were 5.6. 3-year average is 7.9. I think the town plans were at 8%. So a touch higher. And then interestingly enough, the 5-year number fell right in line with those state averages at about 5.2%. And that's probably not a surprise, right? Because I think your three plans, as you know, are relatively mature and otherwise have allocations that are representative of what we see, for longer standing plans that lean into equities that we'll revisit momentarily. And then kind of the fixed income sizing and complexion, and then some of the ancillary exposure into the other asset classes is very typical for what we see. So frankly, it's not a huge surprise that the numbers for the three plans are akin to what we've seen more broadly statewide. So that's just a quick view through some governance detail. I don't know if folks had any questions, comments, concerns. Obviously, Becky does a lot more deeper dives on this stuff for you, but it's kind of the time in the cycle where we think it's interesting to step away and look at some of this bigger picture stuff.
Hey, Chris, just a quick question, right? So the market in 2019 returned what percent? So if we looked at it from the S&P perspective, or is that a different from the fiscal year perspective?
Yeah, so Kevin, I could get that for you. I don't have it on the fly here, but that number again is for the 1 year period ending in June of 2019. That 5.7, right? So that kind of represents a plan average. So it's an aggregation of domestic and international equities and fixed.
Right, and it's not a calendar. It's not a calendar year.
Not a calendar. It's a
Correct.
fiscal year. Right.
Yep.
Right. Yep. All right. So that's any other thoughts or questions from the group on the content? If not, we'll get to the star of the show here, and let's run over to, if we could, Melissa, here's just the detail we cataloged for you, right? So again, this is directly from the Milliman reports here. We've already spoken to it, so we won't rehash it. But it's there visually if people are inclined. The employee, the town plan, excuse me, the Board of Ed plan, and then the police plan are all kind of cataloged there. So I think we've hit on this stuff already. So if we scroll ahead 2 or 3 pages here, the only other update quickly, I guess we should just pause for 10 seconds, for everything from what we understand, and Amy, chime in here if you've heard otherwise, but we've been keeping tabs on your behalf as well of the Wells Fargo principal transition. It seems to be going according to schedule. Interestingly enough, after a lot of analysis and work behind the scenes, I think principal decided on the custody front to retain a lot of the systems and protocols that existed with Wells system-wide for them. So I don't really think you're going to see a whole lot in the way of changes. Service model, service team, fees, everything I think is going to be kind of an as-is basis, if you will, going forward. And we'll obviously keep you apprised of that if things change. But I think that that transition is kind of playing out as both these two entities anticipated as well as ourselves. So if we skip ahead, we'll get right into the 3 portfolios here. And again, kind of hit the highlights here, the visual representations of the 3 plans at the end of September. Relatively close in terms of individual plan allocations versus the targets in the far right column, as you remember. So we don't have allocation recommendations for the committee this morning. You will remember, right, that we had done some things under the hood not too long ago. We had recast the inflation bucket a little bit, as you remember. We did resize Templeton down and redistributed those monies, you'll remember, and we can talk about that a bit more. But the larger allocations, equity versus fixed income, and what we're trying to achieve actuarially, I think that the allocations are still kind of buttoned into about where they should be. And then moreover, just as a preview for the committee, the next time we convene, we'll have the benefit of all of our latest capital market inputs and assumptions, and we will formally recast the allocations against those new inputs, and we'll give you some color and perspective around return potential and risk attributes and whatnot. And I think we can have a fairly meaty conversation next time. But I think in the interim, we're in pretty good working order. We did work with Amy in the fall towards the back end of November. I think we did do some raising across the 3 plans just to stoke up the liquidity a little bit in advance of pension needs. And no surprise, right, given the descriptions on what's going on in capital markets, that in all 3 plans, we ended up sourcing from equity and kind of using those nominal overweights as sources of cash, right, just to, again, have that discipline versus the existing target weight. So I think we're in good working order from an allocation perspective and from a roster perspective. I know we've got a couple of questions lingering on Templeton and some other things, and I'll touch on that momentarily. But just as a general statement, I think the allocation and roster is decent. And then I'll pause momentarily for questions, but just to link it, you could, Melissa, jump to, it should be the next page. Here's the aggregation of returns across the 3 plans. And as you know, they share allocations, and there's a little bit of cash flow differential, but the numbers are by and large identical across the 3 plans. So you see, just kind of interestingly, in the upper left-hand corner, $67.3 million collective start at the beginning of the 3rd quarter. Net contributions is advertised a little shy of a $4 million investment gain across the 3 plans, and kind of ending the quarter with about $73.4 million of pension assets. And the net returns are displayed down in the middle of the page. So you see for the 3rd quarter, the plans were up about 5.7%. The benchmark that we've used or using was up 5.6. And then kind of what I had mentioned earlier, right, year to date through September, and these numbers are now higher once again as we sit here this morning. We'll see how the rest of the month goes. But a positive number, in fact, for the plans calendar year to date 3.3 versus 2.8. And then you see the 1 year number as well, 9.1% return 1 year period ending September versus 8.7 for the benchmark. So,
Hey, Chris, just a question, just
Sure.
the allocation mandate. The allocation mandate comes from retirement subcommittee or the Board of Finance, is that correct?
Yeah, I think this is that's a great question, Kevin. So this is right. So we are trying to catalog, pretty obvious, right? I think to everyone, but in the upper right-hand corner, we're simply trying to catalog the representation from an allocation perspective in the plans. And I think those are conversations that we have had, Kevin, with this committee in the past. And I think that's the place where we've kind of always started these conversations. I'm trying to think in, longer term, to what extent the Board of Finance, I think we have shared the investment policy statements and the asset allocation exhibit and the accepted target weights at the subcommittee level with that group as well. So I probably should have a better answer for you, but I think there has been some type of a cross-pollination across those two entities. At least historically has been my recollection. I don't know, Phil, you've been with the effort for a long time too, I know, and I think that's generally the way we've worked it. So I would defer to administration and whatnot, but I think, Kevin, as an example, right, if we were to come back and do our asset allocation work in January and early 2021, when we convene and said there's a need for a change, perhaps. Obviously, we would vet that with you folks, and I think get your input and thoughts. And I would imagine that those revisions would at some point cross the desks of the Board of Finance as well.
Yeah, Chris, that's accurate.
I'm sorry?
That's accurate, Chris.
So at some point, we need to, really, the retirement subcommittee needs to review the asset allocation with you.
Yeah, I think that's the practical way to start it, right? I think that'll kind of, set us forth on that path. So we'll show you all that information in our next reporting and get you back on it and see what you think about it. So I think, a decent quarter, kind of hanging in year to date, 1 year. We won't dwell on the longer dated numbers. We've obviously talked about them a million times. I know this group is rightfully kind of sensitive to relative results and fees and whatnot. And just as a reminder, right, these returns for the plans demonstrated are net of those. It's 49 basis points of manager fees right now is kind of the lift currently. So that is kind of a quick take on pension. Let me pause there for a minute on the allocation front.
So, Chris, let me ask another question. So when you're saying the returns are net of fees, that doesn't necessarily mean your fees. It means the investment fees.
Yeah. The way we do it systemically, Kevin, is it's we just confine it to the investment management fee. That's obviously, as you know, right, by a long measure, the bulk of fees that are incurred by the plans. There are other related fees, our advisory fee, actuarial fees, I suppose, any legal fees that you may incur in administering to the plan that hover around there as well. But yes, the immediate answer to your question is this is just versus that 49 basis points.
Thank you.
I do want to be sensitive to time and know that Tyler has a lot of stuff as well. If folks do not have other questions on the pension information, what I may do is just quickly skip ahead to the OPEB trust and just share some of those summary data points as well with you.
I've just got one quick question. You mentioned, is our discount rate is in where the majority of people are, but does that make it correct given the current market and current fixed income allocation and where fixed income rates are and possible return look like for the next 2 or 3 years?
Tom, I think that's a great question, and it's kind of an interesting. I think your intuition is spot on. I'm going to tell you folks, don't hold our feet to the fire on this, but I think when we run our allocation information in the next couple of weeks, it's going to suggest that the portfolio allocations that you have in place today will not meet in isolation a 6.75% hurdle. I think that number likely is going to come somewhere down in the low sixes, maybe 6.25, something like that. Right. So it does beg the question, just on a relative basis, where does that lift come from? Call it 50 basis points today versus the previewed return potential. And the track record for active managers, as we all know, has been a challenging one more recently, although it's starting to tilt a little bit more favor recently in active management. So that could be a number. That's a debatable number. I do think that the trend, certainly in the state, everyone is having these same conversations as you folks are, of course, is for those discount rates to be challenged lower once again. I think that 6.75 is on the outer ranges, assuming a decent amount of manager alpha, in terms of return potential. So I think the short answer to the question is that, probably the modeled numbers are going to come in lower than 6.75. I think, as you folks know, we take a more conservative view, I think, generally, than does the actuary. And Becky knows this, so I'm not misspeaking. We've had this conversation a million times. They have a much longer forecast period than we do. We model out over a 20-year forecast horizon. I believe Milliman goes as long as 70, 75 years. And they do pick up a time premium. And she, I know, in certain settings has been somewhat more comfortable with slightly higher discount rates than maybe we have. But that's a conversation we can certainly have, and some perspective we'll draw out for you more explicitly next time we meet. But the trend in the state is for, I don't think 6.75 is a number that is a resting point in this kind of race down to lower discount rates. I suspect that number, probably is somewhere in the low sixes. So I think, Tom, your intuition is pretty accurate.
Okay, thank you.
So that's a preview, folks. It's probably a good one just to leave you with as well. So I appreciate the question, and you'll see that detail obviously in our next meeting. Any other items or thoughts on pension? I do know, Lisa, I think you had queried about summary cash flow exhibits, ins, outs, ending balances, and the like. We did catalog systemically and provide that information. It's in the back of the materials. Don't know if folks have had a chance.
I did see that. Thank you. I appreciate that.
So if you've got questions around that, my inclination would be, obviously get them to us and we can help you kind of work through those. Those are not, they're not accounting statements, if you will, right? We would ultimately default into what the custodian suggests, but we're linking that information right out and cataloging it accordingly. So it's pretty darn close. So if you've got questions there, obviously let us know. The only other thing I would offer up just quickly on the pension front, I think there was a second inquiry around the availability of global indices, index options for global bonds, more explicitly. As you know, Templeton, who has struggled mightily recently, has been the global bond representative in the portfolios. We just talked earlier about resizing them down to a 2.5% target rate. Their performance in the fourth quarter has stabilized and improved a measure. And we would, this formal suggestion to the committee would be to kind of stay the course right now with that manager. We certainly have seen in their track record, these type of periods of dislocation, only to have them come roaring back in a pretty dramatic way. And we just want to be mindful of the return cycle and ultimately, if the committee decides that somewhat of a too much of a volatile mandate, we can move forward. But as a reminder, they're very eclectic, they're very differentiated, they're certainly very thoughtful, and they've been doing it for a long, long time. And they do have advantages, pretty healthy yield advantages over the broad global markets, and only a fraction of the interest rate sensitivity of the broad indices as well. So those have certainly been headwinds more recently. But I do think that that track record begins to stabilize. And again, I think there'd be better exit points if that makes sense to the committee. To the question, Vanguard does have a global bond ETF that our research team follows. It's kind of interesting. It's relatively new. It's only been in place since 2018. So we don't have a lengthy track record on it just yet. And when our research folks were talking to their counterparts at Vanguard, they said they have had some problems recently. It's a dollar hedged index. And they have had some problems given their size, Vanguard size, of finding counterparties to hedge currency exposures on occasion. So I think our research folks' suggestion was, right, Vanguard's certainly capable over time, but given the newness of the strategy, and as they work through some of these,
Which one is that, Chris?
Vanguard's ETF, they have a global bond ETF. I thought I wrote down, I didn't. I can send you the detail, but it's in the back of the book. There's a fact sheet on it if you want to peek at it. If no one objects, maybe we leave that information with the committee. And again, happy to continue the conversation here.
Chris, am I reading the chart right? That over the last 5 years, Templeton has underperformed by 200 basis points?
That's absolutely right, Tom. It's interesting, right? So that is, and that is really, as you can appreciate, right? Look at the year to date.
That's hard to do.
It's really kind of banked into those longer dated numbers. What's happened more recently, if you blow out the track record a little bit and you look at Templeton, just bear with me here for 10 seconds. These are the percentile ranks. You know, there are 2010, they ranked at the 7th percentile, 2012, 4th percentile, 2013, 4th percentile, way ahead of the benchmark and peers, 2014 in the top half, 2016 in the top quintile, 2018 in the top quintile as well. It's just very recently where they've obviously not been aligned. Their strategy has not been aligned with what's going on in the markets. So you do see it bleeding into the longer dated numbers. So again, to the point I made earlier, if people are accepting, it's a volatile, it can be a volatile track record. It can dislocate because the manager invests with such high conviction and in such a differentiated manager from that global bond index. We would encourage the committee, again, right, that if this team is up to task ultimately and what they've been able to do over extended periods of time, we'll monitor it. I think there's a better time in their return cycle to exit that strategy than right now is our, our basic edict there, if that makes sense. But yes, Tom, no escaping it that 5-year number is exactly what you said it was. Again, a lot of that shortfall baked in what's happened just over the last several quarters. The front end of that 5-year number actually has a lot of, if you can believe it, actually has a lot of strong relative results in it, and absolute results for that matter. Is that okay for folks?
I have one question. I'm not sure if it's for you, Chris. My first meeting is part of this subcommittee, and I don't know if has the Milliman report been made available to the committee members, and if so, is there any way I can get a copy of that?
Yeah, I'm going to defer Todd to administration. I'm not sure where Becky is with her Val report and what cycle you folks are in.
So we haven't gotten our most recent valuation. We can send you the last valuation that we have, if that's helpful.
That'd be great, Amy. Thanks so much.
Yeah, sure. I'll send it over.
Thanks.
All right, so I do want to be.
Just another question, Chris, right? So I noticed you pulled Vanguard Total World. Vanguard has a total international index fund that's been around since 2013. Why the comparison to the total world versus total international?
So that would be a North American exposure, Kevin, right? So I think Templeton Global Bond, as kind of the name kind of intimates, right, can go anywheres, and it has U.S. exposure in it. It is global in the truest sense. And that Vanguard strategy we showed you from an opportunity set standpoint mimics that, right? Global bond. You did reference the international bond index, right? So that would be non-U.S., non-North American exposure, if you will. So the difference there is basically, the U.S. That latter strategy that you referenced does not have U.S. in it. We've always kind of footprinted that global bond position as giving a manager, a slightly larger footprint to invest across, and just given, right, the size and scale of the U.S. markets, at least giving the manager that wherewithal to have that ability. We can absolutely, and it maybe is a good precursor as well to what we're going to be doing next quarter on the allocation front. We can certainly consider and model and show you folks, if you'd like, dedicated international bond as opposed to global bond. And that might be an interesting exercise to go through if you'd like to kind of work through that dynamic a little bit. But that's the difference, Kevin, between the two.
How come you get all the good questions and Tyler just gets all the fluff questions?
I'm sorry?
I said, how come you get all the tough questions and Tyler just gets all the fluff?
I think he goes first.
Listen, they're tough questions, but they're fair questions and they're good questions. We're obviously here to try to make sure you folks are comfortable with things and understand. So we obviously encourage you to ask all the questions that you'd like.
Yeah.
It's a much better dialogue and better outcomes ultimately.
Thanks.
Again, I don't want to, I'll take the guidance from the committee here, but if no one objects, just in the interest of time, I'm going to skip ahead to OPEB.
Okay, thanks.
So you see that information. And I know Tyler will get you through the DC stuff as well. So I think we've got to, Melissa, scroll down. I thought I cataloged in my notes here where OPEB starts. We've got to go back to, I think it's slide 48 is where I had. There you go.
There we go.
Perfect. So as we all know, right, OPEB looks and feels a little bit different. Larger allocation construct is not dissimilar from the legacy pension plans. The makeup is very different, right? So we continue to be confined to ETF strategies here. And the portfolio, no surprise, right, is largely aligned with target weights. I think we're in pretty good working order. We did work with Amy back in September to put a little bit of money to work and are just being thoughtful on that front, and we'll kind of continue to, on the margin, be sensitive to the liquidity in the program and kind of in a measured manner, kind of bleeding that into the program through time. But the larger allocation construct is in pretty good working order here, and $18.9 million of assets. I think when we ran the balances about a week ago, you're up at the $20 million threshold, given what's gone on in markets at Q4 to date. And the returns on the next page, Melissa, if you would, right, are basically a representation of indices. You see the down in the middle of the page, again, those numbers. It's the ETFs are a little bit of a funny animal, right? You can get a little bit of tracking error in shorter interim periods, right? That tracking error can come from, obviously there's the fee lift, which is about 20 basis points, 19 basis points for the ETFs right now. But, the ETFs are rebalancing occasionally. There's in certain of the markets sampling limitations, right? The ETF can't own each and every security. So there's a little bit of friction and breakage when they're doing their sampling and replication. The indices reconstitute periodically, and they do that in an immediate fashion, right? And the ETFs have to catch up. So there's a little bit of friction in short periods of time, but you see there longer term, right? As you would expect, that the portfolio mimics the benchmark as it should. so you see the plan kind of annualizing, otherwise from our standpoint, expectationally in terms of return, and generating for the last 10 years, as you see there, just about a 7% annualized return, 6.9 here. Again, net of that 19 basis points. So obviously a much more straightforward exercise and analysis here, given the construct of the program. I don't know if anyone had questions or thoughts or comments, but we did want to just touch on that summary data quickly for you. And you see the returns there, you have 5.3% for the quarter, so not dissimilar than what happened in the pension plans and the other numbers as well. All right, well, that's, if folks didn't have other questions, I think that's all we had on the pension OPEB side, and with a couple of the high-level follow-ups, and I'll defer to Tyler on the DC stuff if there's no other thoughts.
Chris, one last question before you go. If you could, the investment selection criteria, would you be able to share that with us, or not necessarily now, if you just send us some documentation about how you go and select the investments? So, because if I look at it, the Templeton Bond Fund, I think it's a 2-rated Morningstar.
Yep. So it's absolutely as you can appreciate, Kevin, right? And we will. So first answer, yes, we'll send you all some slides that kind of shows the research team and the depth there. And as you know, that group goes. Not to talk negative about Morningstar, they're a great organization, but our analytics go pretty deep beyond some of those representations in the star rating. So, yeah, I will send you that
Perfect.
information and show you the resources.
Thanks, Chris. Have a great holiday.
You too.
Great, Melissa. I'll start on page 60. So I'll give you a brief defined contribution update, and then I'll get into the fund. Again, this quarter is typically when we have the current record keeper in to talk a little bit about, plan demographics, and obviously, given the transition, didn't feel it appropriate. I think what we can do over the first few quarters with ICMA, we can have the relationship manager, the new relationship manager with ICMA, come in and talk a little bit about the services that are being provided, the education that was done, kind of give you a debrief after the transition. But with respect to the industry updates, a couple things I wanted to note. The IRS obviously provided their COLA updates for contributions into defined contribution plans, and they remain the same as 2020. So then 19,500 for your own assets. For assets for someone under 50 and a half, and older than that, you can put in an additional 6,500. We did do a survey right around July. We wanted to provide that survey to our clients. Again, this includes nonprofits and corporate plans, but the theme of the survey is that obviously, given the uncertainty around the pandemic, there has been discussions around reduction in employer contributions. And so for the most part, I know it's tough to see there, but 72% or so remained and stayed the course. But there has been discussions around, suspending or reducing or eliminating employer contributions. And that's been sort of the theme over the last few months, depending on obviously business continuity. If you go to the next page, Melissa, the only update I'll provide you with is the Secure Act, if everyone remembers that from pre-pandemic, sort of 2020. It was one of the more sweeping ERISA, bills. Obviously, this plan is not technically ERISA, but the DOL did provide its guidance around income disclosures. So right now on participant statements, you typically get a balance, and that's what you can look at from a judgment of your retirement plan. The DOL felt it appropriate that alongside that balance, plan employees should be provided with a sort of income disclosure. So a projection on what that balance means from income if you're retired. And so we finally got the assumptions that were proposed. I expect ICMA to provide this to employees. So what you'll get next year is town employees will receive not only a balance. So here I have is, say $100,000 in defined contribution assets, but here's what that translates. It's if I were 67 and retired, and here's what the monthly income would project. So no concerns here, no issues that you have to take action on, but just wanted to give you a heads up that was occurring. If you want to jump to page 67. Perfect. What we did, on your behalf is we sent out a questionnaire to ICMA and all of the record keepers we work with, just around data security, right? Data protection, data collection. Obviously, given the increase in work from home, the fact that bulk of a lot of people's assets are in the defined contribution record kept assets, we wanted to make sure that we at least asked the questions around data security. And so we sent this out to ICMA along with 24 other record keepers we work with. We summarized the answers here. So again, the questions are around, is there multi-factor authentication capabilities? Do you have cybersecurity insurance in place? Is there protection for an employee if there was a breach? What are the criteria for that protection if there was a breach? And so, again, the summary is here. It's very high level. In the back of the deck, and Melissa, I won't have you go there, but we provided all of the answers to that question. The reality around this is, we want to make sure that we've asked the right questions around data protection if there was ever a breach. From a fiduciary standpoint, the last thing you want to say is, yeah, obviously there was a breach and we just never asked the right questions. You, alongside this, did the RFP, which also included a large section on cybersecurity. So there were no concerns that we had with ICMA. There's been no recent breaches. We also read their SOC 1 report, which is their system of controls report, which talks about who gets access to data. And typically we'd be concerned if there were exceptions or qualified opinions, which there were not. So for the most part, given the data we've received, and again, it can be reflected in the minutes, we're comfortable with the level of response we received around data protection and data collection. We also did this for Mass Mutual. Go ahead.
Quick question for Maria and Amy. If we pose those questions to the town, would the answers be similar, or is there work you think we need to do on either policies or processes?
I was just unmuting myself there. I would say that Melissa and I could review that with Rick, specific to these questions.
Yeah, I think we just need time to go through the specific questions to properly answer that.
Okay, thank you. That would be very helpful. Thank you.
Lisa, that's an interesting point. There's obviously three parties involved in that data collection protection. It's ICMA, it's the town obviously providing data, and the individual, right? The individual can give personal identifiable information to the wrong person, and that wouldn't necessarily be an issue on ICMA if every data that they provided allowed access. So, it's important, and we've had conversations with ICMA about being proactive around letting employees know how to protect themselves as well, because obviously ICMA can only do their part. So it's something to be aware of, and it's obviously more important now than it was ever before. And I always joke that I can tell you that I had a coffee the day before in Simsbury at Dunkin' Donuts, but people may go 6 months without looking at their largest pool of assets and not understand that there may have been a breach. So it's important that people check in and make sure that they've, multi-factor authentication is only as good as if you actually set it up. So So if we can go to, I won't go, I guess I'll skip to the current funds. Actually, if you go to page 73, real quickly, obviously we have two moving parts here, one being the new assets, one being the old assets. You can see the net crediting rate, which is very important, obviously, to the town, is still at that 2.14%. You could see the performance of the recommended funds, excluding obviously the index funds we also added alongside a lot of these funds, but we have no concerns with what's currently recommended. On the next page, page 74, I will point out that obviously, another concern, the Eaton Advance Fund is a fund that's struggled a bit. A lot of it's contextual, given sort of the market rebound we had off of March was driven by a lot of sort of low quality companies in areas that they don't typically invest in. That's aggressive growth technology companies. Biotech typically is something that they avoid. Companies that don't have a generation of earnings growth, free cash flow, or really, aren't profitable companies, but those have kind of been, running the show in the Russell 2500. And so that hurt them a bit, but it isn't necessarily something that was due to funds that they selected. So we do still have that fund unmaintained. This is probably the first, the last 2 quarters, it's been below, 50% of its peers. If you look at the sort of rolling performance, it's done fairly well. And it's a fund that's roared back, similar to that Templeton Growth Fund. And again, we still have that fund unmaintained because their philosophy has not changed. It's really just the markets that haven't rewarded that philosophy. And that if you go to the next page there, the target date funds, again, these are the recommended funds that we are continuing to use. You can see the T. Rowe Price funds have performed really well over the quarter, over the 1 year, and obviously longer term net of fees, top performing, top decile relative to peers. So no recommendations to change the target date funds. If you look at the on page 78, we can get into the balances. And actually, I think this is important, given that we've transitioned away from the general account at 4%. But let's see here. Page 2 more pages, excuse me. There we go. So this is the 457. Obviously, we saw that dip back in March, given capital market performance, but sort of roared back up to 12.8 million or so. The one thing I want to point out is we didn't, and I've seen this across the board with a lot of my clients, typically see an uptick. If you look at that top line, and remember, obviously back in March, there was a lot of uncertainty around what was going on from a COVID standpoint. I typically saw a big jump for a lot of my clients in the general account right around March. Yes, from a percentage standpoint, it jumped, but from an asset standpoint, it did not. The percentage is only a function of the decreasing equity performance, but for the most part, the assets, went right back up. We didn't see a big flow into that protection of principal asset vehicle. It's been fairly consistent for the most part. It actually decreased over the last quarter by roughly $100,000. So that's something that's, again, unique, I think, to the town. But for the most part, didn't see any big changes there. You can see the 401A is on the next page. Similar story there, no big shifts from one asset class to another, and back up to that $450,000 level, up from $300 back in March. And then the 403, the Board of Ed plan, again, recovered quite nicely on the next page to that to closer to 700,000, up from 570. So some pretty good recovery from a market standpoint. No concerns from an allocation standpoint. Again, if I did see that, big rush to say the protection of principal asset class, we may want to have sort of a discussion around, education discussion around not trying to time the market. We then, over the next few pages, show you the current pool of assets. again, we don't. We're obviously moving away from this these investment options. So I don't want to spend too much time on this. I'll point out on page 83, a couple of the funds that are underperforming are actually not going to be funds that are available next year, come January, the early part of January. Like, we decided that the Templeton Global Fund, not from a performance standpoint, and sorry, I'm page 83, Melissa, not from a performance standpoint, but more from a menu design. We're not typically seeing global bonds in the portfolio, in a defined contribution where the participants have the investment allocation authority. So we went away from the Templeton Global Fund. We went away from the Balanced Fund, obviously in favor of the more dynamic target date funds. And then we went away from, on the next page, Alliance Bernstein Discovery Value, which is on watch. So the funds that you see that are underperforming actually not going to be a part of the new menu. So I'll pause there to see if there's any questions. Welcome the harder questions, Kevin, if there are any.
I have no questions. Thanks.
Again, what's I think going to be great around the education that you're doing with ICMA is, and not to reiterate the fact, but the RFP exercise did save the town employees pretty significant amount of assets and record keeping costs, and I think that's going to be reflective in those educational meetings and the communication. So, and however else you may want to share that over the next 6 months may be helpful, just to let folks know the work the committee does and the savings that work really provided town employees.
So it also helped the performance.
Yep, absolutely. So that's all I had.
Any questions for Tyler or Chris? No. The only thing I wanted to bring up to Maria and maybe Amy are there any items that we need to review from a housekeeping standpoint or from a fiduciary standpoint on an annual basis, or a policy we haven't reviewed in a year or so, a couple of years? It's kind of off the cuff, but you don't have to answer that question. If you want to just review that and then let the committee know if there's things that we need to do from a fiduciary standpoint.
Yeah, so I actually can answer that. Actually, Chris and Tyler are really good about putting forward the policy. And I think that the Board of Finance just recently reapproved the investment policy when we changed our allocations a couple months ago. So you've already done that for this year. And there's nothing else I can think of that you guys need to do. Like I said, Chris and Tyler are really good about bringing forth on a quarterly basis anything that you all need to review and reaffirm. But typically it's the policy that goes once a year, and you guys have already done that for this year.
Okay.
Yeah, Kevin, real quick, we actually next quarter spend some time on fiduciary governance processes and the best practices, and so we'll spend a good 10 minutes talking about what committee should be doing and how that compares to the current committee.
As part of that, I would kind of like to just review the allocation mandate as well, and then also from the investment selection, a little bit more in depth. It doesn't have to be too in depth. Any other items to discuss? No. Hearing none, is there a motion to adjourn?
I'll make the motion. This is Tom Potter.
All right.
Adjourn.
Second. Thought I heard Todd say second, so all in favor, aye.
Aye.
Aye. Hey, have a great holiday, everybody.
Yeah.